Get ready for the redistribution of your money. In this episode, I'm going to address the Biden tax plan and beware if you earn more than the average American because income tax rates will be going up. And I'll explain why and how this will likely take place. So I'm Doug Andrew, and I've helped many people optimize their financial assets for more than 4.5 decades and also minimize unnecessary tax. Now, let me say this. I'm a red-blooded American. I think we should all pay our fair share of tax. But I've noticed that this isn't really political, Republican, Democrat, whatever you feel about the best way to have government programs be funded and so forth. Basically, there are two basic philosophies. You can raise taxes, which oftentimes causes unemployment to go up. It is actually what causes sometimes recessions to trigger and occur. Or you can raise the revenue that's being taxed. So some tax policy is designed to raise the revenue that's being taxed, and that actually is accomplished many times by lowering taxes. If you want to just raise tax revenue by raising taxes, there are consequences or repercussions. So Joe Biden has many initiatives that he stated during his campaign that he wanted to be able to provide more for certain individuals and classes of people in order to get their vote. And he was elected, okay? So if you earn more than the average American, you will likely see your taxes increasing. Now, it's going to be interesting as this gets implemented, but during the Trump 4 years, Donald Trump lowered taxes, and that stimulated the economy. He believed in raising the revenue that's being taxed instead of just raising taxes. And so that's why the economy went crazy. And so the revenue increased, and then that actually brought in a lot of tax revenue, even though he spent a lot of money. Well, President Biden, he has indicated one of his first initiatives is to repeal the Trump tax cuts. Now, if he just did that across the board, that means that people that were paying 22% in a certain income bracket would go back up to 25%. They would have to pay another 3%. People say, well, that's not very much. Well, it's another 3% of income. If you move from 22 up to 25, that's a pretty substantial increase when you look at what percent of 22 is 3%. That goes up 1/7, okay? You have to pay 1/7 more in taxes, which is not just 2 or 3%. Are you understanding what I'm talking about here? So if you simply repeal the Trump tax cuts, those that are currently in a 22% tax bracket go up to 25 or at least 24, because the Trump tax cuts also allowed people earning a little bit more money to pay no more than 24% up until the next threshold. Those would jump back up to probably a 28% bracket, and then 31% and so forth. So when you look at it historically, after the September 11th terrorist attacks, who was president? Okay, that was George Bush. And so he was more of the philosophy that when we're hurting, you raise tax revenue by raising the revenue that's being taxed. And that's why he had the 2001 and 2003 tax acts where he lowered tax brackets from 28% down to 25%. What Trump did is he lowered that down to 22, and the next bracket from 28 down to 24. So if President Biden wants to repeal those, that's going to hurt a lot of people who make even less than $80,000 a year as a married couple. So that would be an average of maybe $40,000 each between husband and wife. And that's the middle income Americans that he did not want to hurt. So it sounds like at first he said, oh, I'm only going to do it to the people making over $400,000. Well, that's couples. That would be a single taxpayer making over $200,000. He will start there and raise them up to 39.6% and maybe higher. But then he's going to have to do some other things or get rid of deductions, which will actually cause middle income Americans to pay more in tax. So my warning is, if you earn just a little bit more than the average American earns, and I would say that would be $50,000 or more a year, or $80,000 to $100,000 or more a year for married couples filing a joint tax return. If your income is higher than that, beware, you will likely be paying more in tax. Now, this is just income tax. On this channel, I post a lot of in-depth answers to questions that are asked all the time. So I would encourage you to subscribe, click like, share this with others who may be interested in this, because I have additional videos talking about the capital gains tax that he's going to double, and President Biden wants to increase the estate tax by 50% from 46% up to about 67%. So there's a lot of different taxes where he wants to raise them in order to fund a lot of the initiatives that he ran on. So what does this mean for you, and what can you do to sort of be immune from taxes going up with any of these ways that government taxes us, in order to come up with the wherewithal to fund, Medicare for all, or a forgiveness of student loans? And some of these are going to be extremely expensive initiatives if they get passed. The money's got to come from somewhere. Well, let me show you how to take ownership and avoid unnecessary tax. So here we go. So since this video is primarily focused on income tax, a lot of people have enjoyed for years being able to deduct what they contribute to IRAs, or be able to contribute pre-tax dollars to 401ks. That's the most common way Americans seem to get duped into saving for retirement. And I say duped because they don't know what they don't know, because you can't be aware of something you're not aware of. And when do people become aware that they're going to get taxed to death in retirement? Unfortunately, when they retire. And they go, oh my heck, where have I been? Because most people are not in lower tax brackets when they retire if they save very much. But let me simplify this. Let's say that you were making $100,000 a year. That's a nice round number. And if you contributed 15%, the maximum allowed, let's say, into a 401k, that would be $15,000. Well, that's pre-tax. In other words, you only have to report $85,000 of income on your tax return. Or if it's an IRA, you report the $100,000, but you get to deduct $15,000 that you contributed to an IRA. So you're only paying tax on $85,000. President Biden looks like he wants to eliminate that. He wants you to report the entire $100,000, not $85,000. And he's going to try to make up for that by giving people a credit if they contributed to something like a 401k. But if you contributed enough to where you could take advantage of the full amount, he doesn't want you, if you're a high income earner, to benefit from that. So it's going to be a flat credit. They're thinking like 26%. So if you're a low income earner, it would behoove you to participate in a traditional IRA or 401k if that's what you're looking at. Now, I've never owned an IRA or 401k, and you can learn why. But if that's what you're thinking, should I participate in a traditional IRA or 401k or a Roth? If you make more than the average American, I would say go with the Roth, because with this new initiative, you're going to be better off. You're going to lose some of the tax breaks that you used to get, so it'd be better to just pay the tax on the contribution money, what I call the seed money. Because if you were a farmer and you bought your seed in the springtime and you didn't have to pay tax on the price of the seed, but you work, you plant, you cultivate, you irrigate, and in the fall, you now harvest and you have to pay tax on what you sell your harvest for. That's a traditional IRA or 401k. You pay tax during the golden years. Well, based upon what I'm sharing with you, it would behoove you, if you earn more than the average American does, that you choose a Roth and just pay the tax on the seed and enjoy the harvest without the tax. That's a step in the right direction. Now, I don't put money in a Roth because my favorite vehicle, which I call the Laser Fund. Laser is an acronym that stands for Liquid Assets, Safely Earning Returns, has the two benefits of a Roth and four additional benefits that Roths will never have. So why would I own a Roth when I can have the two benefits of a Roth and four additional benefits? It's like 3 times better. and it actually can outperform a Roth by sometimes 3 times as much money. The point is this: if you are earning a little more than the average American, or if you are a saver instead of a spender or consumer, if you're wanting to save more like 12, 15, 20% of your income so that you can maintain the same lifestyle in retirement or even better than during your earning years, let me share with you the better and even best way to save, because being in traditional accounts is not going to be smart for you if you make money and you save money. Now that sounds counterproductive. Unfortunately, that's what sometimes government does. They hurt the people who are trying to be responsible and accountable and make more money and save money. So I've always helped people sort of redirect that and take ownership themselves instead of relying on government to redistribute our money to try to be fair. I found many wealthy people voluntarily give 20 and 30% of their money because we generate so much income tax-free that they go, you know what, I just want to give to this charity and this cause. And they like giving to the causes they support instead of just rolling over and letting government decide what to do with their tax dollars. Does that make sense? So let me share with you what to do better with your money and even the best way to go. So unfortunately, if you save and invest, Uncle Sam taxes your money. The government seems to be there with their hand out. Have you noticed that? Well, that's why my favorite vehicle I call the Laser Fund. It stands for Liquid Asset Safely Earning Returns. That spells the acronym LASER. What is the Laser Fund? It's the only vehicle really in the Internal Revenue Code that has been grandfathered as sort of a sacred tax-free cash cow for over a century. And so it knocks the socks off of traditional IRAs and 401ks. It has the 2 benefits of a Roth and 4 additional benefits that Roths will never have, because I can put in a lot of money into the Laser Fund. You cannot contribute very much money into a Roth. In fact, if you make too much money, you don't even qualify for a Roth. That's why a lot of savvy CPAs and tax attorneys call this the rich man's Roth. I can put in more money. I don't have to. I can make up for years that I didn't put in the maximum. You can't do that with a Roth. If I put in a lot of money because I have a banner year, I can take some out 30 days later. There's no penalties. If you touch a Roth or a traditional IRA or 401k before age 59 and a half, there's a penalty, or before 5 years, and there's all these strings attached. I don't like those. So I choose to put my money in the Laser Fund, and then also with indexing, which is a strategy that I use, I'm able to participate when the market goes up and not lose when the market goes down. And at the end of the day, when I die, anything I leave behind increases. It blossoms in value and transfers totally income tax-free to my wife, my kids, a church, a charity. And people say, wow, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with otherwise payable tax that most people shell out unnecessarily. Is this intriguing you? Learn more. I'll tell you what, I will gift you a copy of this 300-page book, free. You simply go to laserfund.com or click here below and contribute a nominal amount towards the shipping and handling. I'll cover the rest, and I'll send out the book to you absolutely free. It's 300 pages of charts, graphs, explanations, and 62 actual client stories to help you get it. And then as you study this, you'll know how to redirect otherwise payable tax and protect yourself, still pay tax. Hello, we all should do that. But take ownership for your brighter future so you will not outlive your money at the time in life you need the money the most.